Hi everyone. Gotta get everything. When I do this, I'm like the DJ. I've got to get everything going here. So bear with me, and hopefully everyone can hear me. Can someone let me know if they can hear me? Okay.
Yep, I can hear you fine.
Oh, thank goodness. Well, it's good to see everyone on here today, and gosh, it's to be the last one of the year unless, I don't know, some other major chaos happens between now and the end of the year. Knock on wood, the year's not over with. This has been a very crazy year, and it's funny as I talk to clients, I would have never expected that in February or March I would have told you that your accounts would be up as much as they are. Markets really have recovered, and I'm grateful to that, because I think sitting around home and having to deal with COVID, if our money was melting, that would be even a worse scenario. So I'm grateful for the outcome, and I guess grateful for the money the government threw at the situation, and even I think more grateful now we have such brilliant minds, not only here in the US, but globally, working together on a vaccination, which is something that, talking to various colleagues of mine in the medical industry, said it was just unlikely to happen. And because of all the other challenges that come along with it. So it's great to know that we do have a vaccination, and for many of us can get back out in the world and be able to enjoy it. So, and I will be more than grateful not to be having to stare at a screen all day, and I get to actually see all of you in the flesh. So with that being said, I would like to go in and go ahead and start what we're going to talk about today, trying to always be conscientious of your time. And let me do a share screen here 1 second. Here we go. Okay, as we go kind of through year end, hopefully you're able to see my screen okay. There's a lot of things that happen toward the end of the year that are important items to look at, and not only for this year, but also projecting even into next year. There are a lot of moving parts. I kind of half-heartedly joke, hopefully by this time we will know who, and at least shortly we'll know who our president is. I think we all kind of know, but officially it would be nice to know who our president is. And I think that's going to give us better direction on policies moving forward. I think a lot of policies will be a little bit harder to get through, considering we are still in the thick of a recession. So we went through and looked at 14 financial tips to act on before the end of the year. And some of these may be relevant to you, some of them not. Some of them we may have already discussed with you, but let's go to the next page. Oh. Okay, I've given a little depth to this. Some of these items that we're going to be talking about are for those of you that are itemizing. The itemization for a single person is around $13,000, $14,000, and for a couple it's around $26,000. Now, one thing when itemizing is you are still itemizing everything on a state perspective. So don't not do your itemization as usual. You should still do your itemization, as they are still tax deductible against California. The other thing is, it's been interesting on the California and federal, is I'm actually finding more and more of my clients paying about the same amount of money on their California taxes as they are their federal. Not everyone. A lot of folks are still paying less on the state and a lot more on the federal, but there's a lot of, because of the standard deduction and a couple other moving parts, it's not uncommon to see your taxes being equal for both federal and state. So this first one we're talking about is prepaying 2021 residential real estate taxes for a 2020 discount. And There are caps to that, but if you prepay, it might help your itemization. You can prepay your April property tax. So that will help include on that. Remember that 13,000 for the single and 26,000 for state. There still is a cap on that though. The cap is still at $10,000 per year. Let's go to the next one. The other one is the charitable giving. Now, whenever I talk about this, I sound horrible when I say this, but the tax law has moved and shifted. And so the problem is charitable contributions, if you are not itemizing, you're not getting a tax deduction. And so for a lot of our clients, we're saying, be aware of that. And it may make sense to do charitable contributions in lumps. So if you're someone giving $5,000 a year, that may not have any tax benefit to you. But if maybe you do this year and next year's in this year, then you may have maybe very tax beneficial. So I think that's great. I guess you guys aren't seeing my screen. Let me try again. Okay. Are you seeing my screen?
We can see it.
Yay. Okay, thanks. Thanks for letting me know, guys. Still learning this thing. So there's a couple things that we do when we talk to clients that are charitably inclined is we talk about being opening up a charitable account. You can open up one at Schwab or Fidelity. It's pretty easy. The other thing we say, hey, if we know you're going to give $5,000 this year, $5,000 next year, $5,000 year after that, sometimes we can front load that a little bit, maybe do a few years worth when you're in a high income year. The other thing we look at is not just giving cash, but maybe highly appreciated positions. If it be something that we hold, if it's a mutual fund or a stock, you can actually take that charitable contribution or that stock, let's just pick on any stock, Apple stock you bought for 100, now it's worth 200, and now you have a big capital gain on that. You can actually just donate that stock to the charitable account and it gets sold immediately in the charitable account. So sometimes we say, okay, well, let's, like I said, do a couple years worth so that you can get the tax benefit of it. So I know it sounds awful when I say that out loud because it sounds like I'm insensitive to the charitable organization, but it is kind of the parameters we're in, and we want to try to optimize it as much as we can on behalf of our clients. Number 3, pay home business expenses. So that's going to be a really big one for all of you that are working from home this year, because there are a lot of home expenses that you will get this year that you normally don't do. Typically, my accountant does not like to do home office expenses. He says one of the things the IRS loves to come in and audit you on. This is going to be a very different year. So one of the things that you may want to look at is if your HP computer's on its last leg, or your HP printer, or anything that you think you're going to need to buy for next year, you may want to buy that this year so that you can take that off as a business expense, again, while you have an at-home business expense. It'd be good to, if you are working with an accountant or familiar with some of the things of expenses on your home, if you're using 1/5 of your home for a home office, there's some advantages of 1/5 of your internet and 1/5 of your electrical bill and 1/5 of your other expenses can come off in this. So be a good time to start putting those things together in advance of the end of the year and spending. I have some.
外面看着都很好的，一切切开来，里面都是那种 soggy 的黄颜色的。
Hear me and all. Okay. If you're self-employed, establish a retirement plan for the future and get tax benefits. So one of the things that we talk to our clients a lot about is if you're self-employed, we do a lot of solo 401ks. And it used to be people did SEP IRAs, but now it's more solo 401ks. The biggest advantage of a solo 401k is it's not 20% of whatever your self-employment is. You can go up to the maximum amount, which is $19,000, And if you're over 55, you can do the catch-up provision. So you can put more in there. It's not a percentage of income. So you could essentially put 100% of everything you make into a 401k up to those 401k caps. And so those are good things to take a look at. Solo 401ks, though, you have to have it open by the end of December. Does not mean you have to fund it. It's just not, you can fund it later. You just need to have it open before the end of the year. So a lot of our clients kind of take a look at that, look at their numbers, what their tax liability is going to look like this year, and kind of determine, does it make sense to open up a solo 401k, and then also later funding that. Making estimated tax shortfalls with increased holdings. I don't think there's a lot of time here for, if you're a W-2, to be able to do much more withholding, but it's good to look at tax estimates, especially if you took some capital gains. If you're getting a bonus, usually those are fine. Severance packages tend to be capped at 28%, so you may not have had enough withheld. I always say it's not necessarily, you could pay it before the end of the year to avoid penalty. I am always in the shock value estimate. You know, if you know you're gonna owe how much, and I'd rather know if you're gonna pay $5,000 or $25,000, be prepared for it and be able to pay it in April than to have a surprise that comes out of somewhere out of left field and you weren't prepared for it. The other thing is, if you know you're going to get a refund. So sometimes our clients will build that into cash flow if you're looking at tax estimates. If you're a TurboTax person, a lot of people will just get out there and just kind of play with their last year's tax returns and run kind of their current numbers to go, okay, there's a little box in the corner that says how much you owe or how much you're going to get back. And if you talk to your accountant, he or she can also run some estimates. So it's good to take a look at that before the end of the year. The pandemic loan opportunity. So one thing, I don't have a lot of people that did this, but I do want, one thing I think people underestimate is their unemployment is taxable. And I kind of worry about what that's going to be if you've got a $30 or $40 or $50,000 in unemployment benefits and you didn't have any tax withheld. Be aware you do have tax on that. The other thing is, if you're a business owner and you took the PPP loan, that we do not know if it's taxable or not. So, good to be prepared if you did take that, what you may possibly own on it. For most accountants I'm talking to, they're saying it's not going to be taxable for most people, but we still have no clarity on that. And so very important that you're keeping an eye on some of that tax liability. Roth conversions. Okay, so I do a lot, and I have a lot of conversations with people on Roth conversions. Here's the thing. If you have a year, I always call it a gap year. Maybe you took a year off or your income dropped for one reason or another this last year, you may want to look at doing a Roth conversion. For some folks, it may be a small amount. For others, it may be larger. What is the point of paying, doing a Roth conversion? So typically, I'm not a big fan of Roth conversions. The higher your tax liability is, I would say anywhere over 20% on the federal, and then you've got state, does not make sense to do Roth conversions in general. But if you're under that, for some reason, because your income dropped, it does make sense because you're having the ability to pay some tax on it while you're in a lower effective tax bracket. And the beauty with the Roth IRA is that money grows tax-free, and you never have to take the money out of a Roth. So there's no required minimum distributions. And if you do take it out somewhere down the road, there is no tax liability. The other advantage to it is it doesn't show up against income anywhere else. So for right now, like tax-free bonds, they show up as income against Social Security income. All IRA distributions are taxable. A Roth IRA does not show up against Social Security income, Medicare insurance premiums, so Social Security taxation doesn't show up anywhere. And so it's good to be able to put little pockets of money in there along the way when there is opportunities. Roth conversions and years of Roth conversions are few and far between when we see opportunities. And so you don't want to miss the opportunity. So run some numbers and see if that makes sense. I am a big fan of Roth conversions. I see kind of the progressive taxing that's coming down the pipe for retirees. What I mean by that is one of the things that we're seeing is that the income limits for increased Medicare insurance premiums keeps coming down. It used to be at 280, then it's at 240, now it's at 170, and that number continues to creep down. So it's not uncommon that, you know, you may say, well, I'm never going to make 170,000 in retirement. The problem is that's today's Medicare amount. That 170 could very easily come down to 150, 140, 120. And we're seeing Medicare insurance premiums for some folks increase $200 a month to $10,000 a year. So it's the Roth is not in that equation. So it makes it a great planning tool. Health savings. This is a big deal. And I think this is kind of a shift that is a different mindset for many people is what is a health savings. I always get people confused flexible savings account with a health savings account. Here's the thing, flexible savings accounts, if you don't use it, you lose it. In a health savings account, you don't lose it. Even if you die with it, your kids inherit it. It's not a use it or lose it. So you can build it up. If I had to tell my clients any one thing that's a powerful tool, it's the HSA, because we get the trifecta. And what I mean by trifecta is you don't pay any tax going into it, you don't pay any tax as you let it grow. As long as you use it for healthcare expenses, you don't pay any tax when you take it out. So healthcare expenses are a variety of things from eyeglasses to even acupuncture, health insurance premiums, long-term care insurance premiums. There's a lot of things you can use this money for. For me personally, I treat it like an IRA. I put it in a growth investment vehicle. I let it rock and roll. I don't plan to use it until I'm older, somewhere down the road. So the caveat is you got to qualify for an HSA plan. And that all depends on the health insurance plan that you enroll either through your employer or on your individual level. It is, like I said, a powerful tool to be aware of. And I think if you're looking at, sometimes people don't really realize that an HSA plan, an HSA eligible plan, you have to have a high deductible plan to it to be involved and enrolled in it. Sometimes that dollar amount is like $200. So you could be in a non-HSA plan and it may change your health insurance premiums by $200 throughout the year, but you could have been eligible for an HSA, which is a tax deduction. Again, you put that money in, that $7,100 comes off the very top of your tax liability. So as a tax deduction. So I think it's powerful, be aware of it. Also, Fidelity and Schwab finally have HSA accounts. We used to tell people, you got to go out to Optum Bank or here and there in the credit union. The problem is, like the credit union, you earn whatever they're paying in their bank accounts. Is next to nothing. So now you can open an account through Fidelity and treat it just like an IRA, invest it in however you want. So, you know, depending on when you're going to think you're going to need the money, so on and so forth. One thing to also be aware of, once you turn 65, you are not eligible to contribute to an HSA. So it's not infinite in how many years you can put money into it. Let me know if you have any more questions. This one's kind of a loaded topic, but very powerful. Another one is to leverage your losses to protect your income taxes. So many of you may have heard us talk about it through the course of the year as we did tax loss harvesting when the markets were hairy back in February and March. Purposely took losses, repositioned the position in the portfolio, and now there's losses there that sit in your back pocket. And those are very powerful. They can be used against gains, future gains next year, 10 years from now, or you get a $3,000 tax deduction for those losses. So those are important things to take a look at this year. Don't miss your employer 401k match. One common mistake I have with clients is, well, if you're fortunate enough, you're getting raises and you're not adjusting your 401k contribution. I have yet to see a 401k that lets you put in a specific dollar amount per pay period to max it out for the year. You have to use a percentage. So you really want to make sure you do that through the entire calendar year. Because you'll miss the match if you don't do that. Some companies used to do it was called a true up match, which was awesome. It's like, okay, if I screwed up and I funded it too fast, I funded it in October, I didn't miss the match. Most companies took that away. I've not seen one that does a true up match. It's been a while. Basically, they say, well, you messed up. Why do we have to pay for your error? It's less out of our pocket. Tough luck. So you really want to make sure you optimize that 401k over the course of 12 months. Maximize Roth IRA contributions. If your income's under a certain level and you have earned income, we try to squeeze as much money in those. And you've probably heard me say, anything with compounding interest is your friend. It's the fastest way to accumulate wealth is through compounding interest. So that can be your 401k, a pre-tax IRA, a Roth. You've heard me talk about HSAs, 529s. These are the only vehicles we have that allow for compounding interest. So you want to optimize those as much as you can. Let's see. And beneficiary designations, it's been interesting with COVID how many have reevaluated their living trusts, their wills, and also take a look at your IRA, your 401k beneficiaries, and making sure those are accurate to how you want those to be deployed if anything should happen to you. It's just a routine item that most people kind of oversee. It's not uncommon, especially for my clients there at Hewlett Packard, that they're missing beneficiaries. And so often when I'm in there with my clients looking at their 401k, it's one of the first things I just check mark and say, okay, it's in there. Now, often clients will name their spouses as beneficiary. They don't have a contingent beneficiary. Downside with that is if you're in a car accident together and you've named each other as beneficiaries, but no contingent beneficiaries, you may have a problem. So naming contingent beneficiaries is important. Give today to reduce a future estate. Most of us don't have estate tax issues, okay? Right now, the current estate tax limit is $11 million per person, $22 million. For most of us, that doesn't impact us. But there is a lot of conversations in Congress right now. I shouldn't say Congress, right, because we have a split Congress, they're a hot mess, but let's talk about Biden. He has really kind of stressed that he'd like to bring the estate tax down to $3.5 million per person. So it'd be $7 million per household. Now, I don't think you should get out and be proactive on this because, again, we have a split Congress and Biden has a lot on his plate. Again, assuming he's president here any day now, anyways. So at some point, if that should shift to $7 million a person, it is something that's going to impact a lot more people. One thing to realize, your estate tax includes all your retirement accounts, your brokerage accounts, but it also includes the value of your home, regardless of what you owe on it. So if you have $1 million home and owe $1 million, does not matter. That $1 million is still part of your estate, regardless of the loan. The other thing is if you have a life insurance policy, let's just say you have a life insurance policy through your company or any other kind of term policy, all of that gets included to your estate. And so although it may seem like 7,000 is a stretch, it can get there quicker than you think. So obviously, if this is something that does happen in the future with the changes in tax laws, you will hear more out of me because we will have to do and think about more estate planning techniques. Okay, but for right now, most of us don't need to worry about estate tax. Revisit risk tolerance and portfolio diversification. I think the market's been really good, and the challenge with markets being very good is we think we have a higher risk tolerance than we really do. And taking a step back and really realizing what's going on with your personal life. When are you living off of these assets? Are you not touching these assets for 10 years or more? One of the things we talk about commonly with clients is if you're not touching the assets for 10 years or more, you have a 90% chance of making money in the market. So play those odds. But if all of a sudden you're saying, oh, Jody, I've got 3 years till I'm going to start using those assets, then all of a sudden your statistical odds of making money in the market are much more difficult. You have a 70% chance of losing money in the market and 30% chance of making money in the market. So, really kind of understand where that fits in the plan, where that fits into your risk tolerance. The other thing I listen to a lot of people talk about risk tolerance, and the challenge with risk tolerance is if you don't take on enough risk in your portfolio because you have no risk tolerance, then you will need to spend less, work longer, and save more. And so there's that conversation of, you know, for most of us, we need to take risk in our portfolios because most of us don't want to work forever and we only have limited money to save. So we've got to take on some risk in our portfolios. So it's that balance of how much risk you should take. And I always say how much you need, not what you want what you need. So what I mean by that is, again, if you don't take on enough risk when you're 60, 65 years old, you're going to run out of money sooner because inflation is going to implode it. So it's a balancing act of managing your risk. I always say risk tolerance. None of us want to see our money fluctuate. You always feel a little bit fat and happier if all that money's just sitting in your bank account doing nothing, and you don't have to worry about fluctuation. But for most of us, we need to have our money hedge risk, and it does need to grow for us so that we don't run out of it. And the bigger challenge is none of us, at least no one's consulted with me when your die-by date happens. So if we knew when that your expiration date would happen, that would change the math behind everything. But for all of us, we don't know when that day comes. So making sure that that you don't outlive your money is very, very important. Those are the main things. I'd love to open it up. I'm going to unmute everybody, so be aware of that. Let's see. I'm going to unmute everyone so I can just take questions. And yeah, ping me with questions, anybody. Hopefully I can answer them. Questions from anyone?
Hey, Jody, this is Gary.
Hi.
When I was self-employed, my solo 401k, there's the employee contribution side, which is the 19K, but there's a bigger chunk that's the company side. So if you're self-employed, remember the company side, because the company, which when it's you, is a lot more generous than other companies and contributes quite a bit to your 401k.
Yeah, you can actually get a total of $56,000. It might be a little bit more than that into a solo 401k. There's the salary deferral, but then there's that, like Gary's saying, there's that if you own a corporation, it can do a profit sharing, and it can be pretty powerful from a tax deferral. And we like solo 401ks because one year you might have an amazing year, and then the next not so much. So you don't have to put money in if you don't want or if circumstances change. So it's a great tool to have in your back pocket. I have some clients that, you know, have done consulting from time to time, and we just kind of let it sit there and let it be available to them if they ever do become consultants and don't necessarily need the income, so on and so forth. It's a nice self-employment component to have. Thanks for pointing that out. Any other questions?
Hey, Jody, it's Mark.
Hey, Mark.
Hey, I think it was your second slide on charitable deductions. That was for people that are itemizing?
Well, and I also talked about if you're doing it, be aware of if you're not itemizing, how to kind of bulk it up from one year or the other. But if you don't itemize, it's not getting you a tax deduction, which again, it sounds horrible to say, but sometimes it's working smarter, not harder. And if you are charitable inclined every year, and it's just something you do, we say, well, let's open up a charitable account. And let's say we know you're going to do $5,000 next year. Why don't we do 10 this year? Put in a charitable account. You can still give it to your organization next year as you do, but you'll be able to get closer to that itemized amount. And you know, they have those charitable accounts, they have it even set up so that you can have it like almost like a bill pay. That sounds bad, but some of my clients that, you know, they go to church every week and they feel bad they want to give every week. So you can actually have it set to go to your church on a weekly basis. The other thing is, from something I didn't bring up, was required minimum distributions. I know we didn't have them this year, but you are still able to give required minimum distributions. Some, none, whatever, but you can still give that to your charity of choice. The difference with RMDs and charitable contributions is it does have to go directly. But let's say hypothetically, you want to give $10,000 to your organization next year. and you have $50,000 of R&D, you can actually take the first 10,000 of that R&D and give it to your charity, and it reduces your tax liability from 50 down to 40 because you've taken that off the top. That is still on the allowable from a tax perspective. They keep talking about wanting to get rid of that. Thankfully, it's still there. I don't know why they would get rid of it. Sometimes I don't understand things in Congress, but it is still there. And it definitely is something to utilize if you're over 72. And by the way, the RMD amount is now 72, not 70 and a half. So if you are over 72 and you are charitably inclined, it's a good thing to use that. And we'll help you move that money to your organization of choice. Just let us know. Any other questions? Good question, Mark. Oh, one other thing, I'm going to kind of talk about this. Does not mean I want you to be proactive on this. But one of the items on the docket that I do think will get passed through Congress, I may be wrong. I've been wrong before, many times, but the long-term capital gain rate right now is 15%. And actually, if you're in the 12% tax bracket or lower, it's zero. You pay no tax on capital gain. I do think that's going to increase. I do think if I had to pick any tax law that's been around, circling around in conversations, I think that's one that will go through. And right now they're saying it's only for people with income over 400,000. They'll have to pay tax on long-term capital gain rates at ordinary income level. And really anyone at $400,000 is at 37%, right? Plus the state. I think that number will start high, but I think it will creep down over time and may impact more and more of us. Again, it does not mean I want you to go proactively sell something to pay the tax because of some tax law that we don't know if Congress has anything done. I just think it's something to be aware of. And, you know, I don't think it'll happen next year. I would not be surprised if it doesn't happen in 2022. I think that there's a lot of people that made a lot of money in this COVID environment, and we as a country have a lot of debt, and I think that's a place to kind of snag some of those profits from people that prospered and help pay down that debt. So I think it's an easy thing to kind of go after. We'll see where things progress, but it's kind of one of the things to be aware of. Let's see. Any other questions for me? Any year-end tax planning stuff that you may have questions on? Okay, well, I must say I am counting the days for 2020 to be over. I don't know why. I don't know what suddenly is miraculously going to change in 21 just because of the calendar date, but it's been a tough year for a lot of us, and hopefully we start to see the vaccination come out and for all of us be able to see our families again. And with that being said, I'd really like to say it's been great working with all of you, and we'll continue to stay in front of you on all of these continued moving parts with COVID, markets, tax law, Congress stuff. But with that being said, I hope everyone has a great holiday season, and look forward to seeing you in the flesh next year at some point. Bye, everyone.